But let's invite Neeraj, founder and chief investment officer at 3R Investment Management, now joining in. Thank you very much, Neeraj, for joining in. Top of mind is the uncertainty swirling around the U.S. trade policy. The Supreme Court potentially ruling on the legality of Trump's emergency tariffs later today. So the question is, how will the market react in the various scenarios? One, there is a partial strike down. Two, in case there is a full strike down. And in that event of any strike down, what is the market assuming on how quickly and effectively Trump can impose alternate tariffs? What are the legal avenues? And then in the event there is no change, how should markets react on Monday?
So I think overall you will not see a significant reaction with the exception of maybe the immediate knee-jerk. I think two aspects you have to think about. One, from a tariff perspective, if anything, you've seen the tariffs getting watered down over the last 6 months. In fact, post-April, if any, the tariffs have been obviously seeing exceptions to obviously manage inflation and other supply chain aspects. So it's not as if the headline tariff, what it was expected to be, is where we are. We are way below that. The second thing is from the standpoint of the Supreme Court verdict, I do think the administration has ample avenues through the different sections to re-put whatever if they want to. So I think there will be a knee-jerk reaction, but I would expect the markets to actually look through that because some of those tariffs that the administration wants to keep will come back through a different channel. So I'm not sure it actually changes the path from the broader fundamental perspective here.
Not even for Neeraj, hi, morning, and wishing you a better 26. Happy 26. Good to see you. Not even for in a short-lived sort of, near-term way for a badly hit market like India in terms of relief?
So I think there will be a near-term reaction. There certainly will be an immediate, as I said, knee-jerk on the back of the ruling you will see. From an India perspective, I'm in a more positive camp just by virtue of the changes we have seen, whether it's in terms of tax cuts flowing through some earning recovery that you would expect this year, as well as, I would say, the max tariff uncertainty behind us and the rupee seeing signs of stabilization. So I think India is a slightly broader discussion on what drives 2026 from a calendar year perspective. But from a tariff side, yes, it will see. But the broad tariff uncertainty around the trade deal, I think that still has to get out of the way.
Hi, Neeraj. Morning. Good to see you, Ben. Plenty of worries, right? Uncertainty on tariff. Don't know what Trump's going to do next. And now suddenly geopolitical issues again are creeping back up. How big a risk is that?
So there is obviously pockets of geopolitical uncertainty, but markets have been looking through it. To some extent, obviously, the markets have gotten a bit complacent because nothing is at an individual level that big. I do think the impact of that, even though you have a broad positive backdrop from a fiscal and monetary policy standpoint globally, is the geopolitics risk will lead to higher volatility in 2026, but not necessarily a turn in the market direction.
But just the knee-jerk reaction on the U.S. markets, Neeraj, because on one hand, they will be losing the tariff revenue that they have collected so far, and it's quite sizable. There will be refunds, reimbursements to do. But on the flip side, it does open up global trade, the tensions between U.S. and various other countries. So how will U.S. markets react in the event of any sort of a strike down or a slowdown?
So I think it's obviously it varies by the asset class. It's negative for the treasury markets, the US rates, because obviously a part of the fiscal financing market moved towards calculating the tariffs as a part of the fiscal financing, which is running at around close to $2 trillion of deficit right now. What are rate tariffs for the full year? And I think markets will reprice that, which means it's negative for the treasury markets. Equities will be mixed based on the sectors.
Yeah, I mean, what has happened so far, it's all upside down, right? Middle of last year, there was expectation that it's bad for growth, so hence bad for equities. None of that played out. And all of this is, equities are having a great time. So if this throws everything into a bit of a confusion, I guess it is bad for equities, near term at least. That's the... if something is going well and it gets interrupted, it changes direction for a little bit. But I guess long-term yields go up again, because of those fiscal calculations, fiscal fears returning?
I do think the long-term yields go up. You will see potentially a further steepening of the US curve, which again, depending on the levels, is beyond a point is not great for risk assets if you see a significant backup in the long end of the curve. So to your point, I think the immediate reaction, the equities might be negative. And then you have obviously a mixed picture under the hood in terms of which sectors take a bigger hit based on the interest rate sensitivity.
Neeraj, is good conversation. It's a bit near-termish, but it's all near-termish right now. I hope you'll join us once we have the decision from the Supreme Court in terms of the shape, size, form on tariffs as it comes later tonight. Thank you very much for being here on CNBC TV 18.
Thank you.